Hi folks, my name is Mike Zlatnik, also known as the Big Mike, and today we're going to talk about investment quadrants in real estate. Wonderful disclaimer. This presentation is for informational educational purposes only. We're not offering any kind of advice, nor are we offering to sell anything at all. If you're interested in our family or fund, please request private placement memorandum for each fund to accredited investors only. Thank you kindly. Investment quadrants, you've heard about the term before. Robert Kiyosaki has his investment quadrants. I have my investment quadrants, and this methodology I developed to help me better understand uh, the risk and reward associated with investing in different real estate deals, as well as understanding which deals are better designed for cash flow and which deals are better designed for appreciation or growth. So Wall Street has the terms of conservative investing, moderate, aggressive. The Main Street terms, or the terms I like to use, is called investment grade or speculative grade. So quadrant 1 and 2 are the deals that are generally speaking low to moderate risk. These are investment grade deals. And typically quadrant 3 and 4 are speculative quadrant deals. There's more risk associated with these deals. That's why they fall into quadrant 3 and 4. Quadrant 1 and 3 are your income focused deals or cash flow focused deals. And quadrant 2 and 4 are your growth quadrants. So let's look at quadrant 1 first. So quadrant 1 is generally low to moderate investment risk, and it's a good cash flow quadrant. Typically, the deals that fall into this quadrant in real estate are such as first lien performing notes or first lien mortgages, as some people call them, typically at the conservative loan to value ratio, as well as conservatively leveraged equity deals. So what do I mean conservatively leveraged? Typically, conservative leverage in today's market is 75% or less. Ideally 70 or below, but 75 is possible for some deals. So conservatively leveraged deals with good cash flow fall into that quadrant. Quadrant 2 deals typically also low to moderate risk, but they have no cash flow from the start. So first lien non-performing notes, moderately leveraged value add projects with break-even cash flow all fall into quadrant 2. And again, it's low to moderate risk. Once you go into quadrant 3, now you're looking at the deals that have a higher degree of risk, but they have strong cash flow in quadrant 3. So here are the examples: second lien mortgages or second lien notes, highly leveraged deals with strong cash flow. So again, conservative leverage is 75%. I've seen deals with 80, 85% leverage. As much as they can generate strong cash flow, there's a lot of risk associated with high leverage. Quadrant 4 deals are generally speaking also high risk deals. There is no cash flow to start with. These type of deals are your development, your redevelopment, repositioning, land speculation, heavy value add projects. And quadrant 4 deals, they're neither good or bad. Quadrant 3 deals are neither good or bad. Same for quadrant 1 and 2. They're different. And the reason this methodology helps is when you get a deal across your desk, you get the opportunity to look at the deal and see what quadrant it falls in and what level of risk you're taking, and make sure that it fits your objectives. Now we're going to look at investment quadrants and risk-adjusted return. So these numbers here are pure examples. The deals could have very different characteristics, could be lower or higher. But this is just a way to think about the problem. Let's just say you're looking at a deal that is a conservative deal and it falls into quadrant 1 deal. For example, you get an opportunity to invest in a first lien mortgage and you're promised 10%, or you're promised the note pays 10% rate of return. You should still adjust for risk. The investment is not zero risk, there's risk. And the risk adjustment for quadrant 1 deals is typically 1%. So if you take 10% note and you adjust it for risk associated with the investment, then the risk adjusted return is 9%. Same methodology applies to quadrant 2, and the same methodology applies to quadrant 3, and the same is quadrant 4, except for risk adjustment is very different between the quadrants. Quadrant 1 risk adjustment is typically 1%. For quadrant 2, it's 2%. For quadrant 3 and 4, 6%. So as you're taking more risk and you're moving from quadrant 1 and 2 into quadrant 3 and 4, you better get a higher risk-adjusted compensation. Otherwise, why take risk? This is the holy grail of investing. If you're taking on the risk, you better have a better upside. And the same is true for the cash flow versus non-cash flow deals. If you are foregoing the cash flow and you're looking to invest for growth, that's wonderful, but you need to receive a higher risk-adjusted return as a result of foregoing the cash flow. Otherwise, it doesn't make the same sense to take all the risk. So these are the very basic principles of the investing. Hope these investment quadrants help you better understand risk and make better decisions. Thank you kindly for your time. Look forward to speak again soon.